and we'll get started. Thank you.
Thanks, Maria. Before I get started, I think it's pretty obvious that I clearly do not pay attention to basketball, and I had no idea that today at noon was such an important time in the basketball realm. So I do appreciate anyone that was able to join us today. Hopefully you have a party and/or a nice beverage waiting for you after this CPE. I mean, you definitely deserve it after listening to me talk about tax for the last hour. So I don't like basketball, but I do like to talk about tax. So with that being said, we'll get started. Here's my contact information. Maria mentioned we do have the Q&A open. Feel free to submit questions, and if we have time, we can certainly get to them. I can definitely follow up on any questions after the fact. So here is a general list of the information that we're going to cover in today's session. I do want to preface all of this by saying that this is going to be a 50,000-foot overview of a lot of different things that you as a manufacturer owner or controller or CFO should be aware of. I mean, each one of these topics could be its own hour-long lunch and learn in and of itself. So like I said, we're going to do a very high-level overview just of things to keep your eye out for and to be aware of when you're looking at your tax returns. And with that being said, it looks like we have our first polling question.
All right, everyone, I just launched the first polling question. Again, the 4 polling questions are required for CPE. So question is, why are you attending this webinar? Of course, it's to learn about tax credits, but are you also interested in the CPE? And then, of course, lastly is both. We'll give it another second or so. Got about 90% participation, so. All right, I'm going to end the poll and we'll return it back to Kristen.
All right, so first topic that I wanted to talk about today is very near and dear to my heart. And if any of you know me, I'm sure we have had a conversation or two about this at some point. Research and development tax credits. So what is a federal research and development tax credit? The federal R&D tax credit is a dollar-for-dollar tax credit to offset federal income tax. So this is a federal tax credit. It is not a state credit. Depending on what states you're in, we could be looking at state credits, but for purposes of our discussion today, we're going to focus primarily on the federal R&D credit. So like I said, it is a federal income tax credit. It was designed to help promote innovation and R&D and development within the U.S. So with that being said, eligible R&D activities conducted within the U.S. could be eligible for this credit. Now, when we're looking at those activities that qualify for the federal R&D tax credit, we are looking for activities that are going to pass what's called the 4-part test. So the first part of that test, as it entails, is going to be, what is my permitted purpose? So what am I trying to achieve with this R&D? Am I trying to develop a brand new product? Am I trying to improve a product? Am I trying to maybe I even have a process. So a process improvement is an area that is often overlooked by manufacturers when we're looking at this R&D tax credit. So maybe I purchased a new piece of machinery and I am trying to make my overall manufacturing line more efficient. That is a process improvement that we could be looking at. And like I said, it is very common for a lot of manufacturers to have these process improvements that we can look at for the R&D credit that go beyond just your regular product that you're producing. The second test is going to be technical uncertainty. So obviously, you don't really have R&D if you know what you're doing. So there has to be some form of technical uncertainty regarding the methodology of going about the research, or if the capability of it, how you're going to get to those intended results. So that would be the second thing that we're looking for. Third test that we're going to look for would be process of experimentation. So if you think scientific hypothesis, what's our question? What's our hypothesis? what are we doing to test that hypothesis? What's our testing process? And then how are we analyzing and evaluating those results that we're getting from that testing process? So really, this is something that we want to be able to prove to the IRS. And this, I'm going to say this for this test, but it definitely applies to all tests. Contemporaneous documentation is truly key when it comes to claiming this R&D tax credit. So not only do we need to be conducting those activities, and not only do we need to be conducting a process of experimentation, but we really want to make sure that we are also documenting that process of experimentation and documenting how our activities are meeting this 4-part test. The last test that we have for R&D would be technological. So it has to be relying on the hard sciences, whether that be engineering, biology, chemistry. In today's day and age, computer sciences are considered to be a hard science. So that would be another aspect that we would be looking at as well. So like I said, these are the 4 parts of the 4-part test that have to be met in order for our R&D activities to potentially qualify for this tax credit. Just some other general nuances to R&D. You know, as I mentioned before, the R&D credit is to promote R&D within the US. So with that being said, you can only claim the credit on activities that are performed within the US. So it's very common, you know, maybe you have an R&D team, let's just say it's in India. We would not be able to take those costs into account because that R&D is not conducted within the US. However, if you maybe have a, let's call them New York State-based team that is overseeing the team in India's activities, as long as the US team's activities are conducted within the US, then we would be able to qualify some of that time. Another aspect that you run into often is funded research. So funded research can come in many different forms, and I always recommend that we take a look at the contract to try to determine if it is funded or if it is not. The easiest way to think about funded research would be, let's say I'm a manufacturer, I receive a government grant to try to produce something for the government, and they're fully funding the research that I am conducting. That would be funded research. As I mentioned, that's kind of, you know, a very simplistic way to put it. It can come in many different shapes and forms. So definitely making sure that we're looking at those contracts just to make sure that it is funded research, because as I mentioned, that does not qualify. So this is kind of a misconception as well. Success is not mandatory. And I oftentimes joke that it's almost better when you do fail, because it's even more proof that it truly was R&D and that you did not, you know, you had that technical uncertainty. We didn't know how to achieve those results. So even if you fail at that project and that project ends up going nowhere, that's still something that we can look at for purposes of the R&D tax credit. And then on the flip side, it's true as well. You know, even if your project is successful, as long as it meets the 4-part test, it meets all of the other criteria, it's okay if it still ends up being successful. You know, we talked about technical uncertainty. Generally speaking, when that technical uncertainty is eliminated, that's when we're going to, you know, consider stopping tracking R&D. But it could still be a successful product at the end of the day, and we could still take into account some of those activities as R&D activities. And then duplicating what others have done can qualify. I feel like this is often a misconception as well, because you might be thinking, all right, well, I know so-and-so, you know, can make a product like this, so it's really not new. It doesn't have to be state-of-the-art and brand new to the world. It has to be new to you. So when we're looking at that 4-part test, we're looking at, do you, as the taxpayer, have technical uncertainty? It is important to note too, however, reverse engineering would not qualify. So if you maybe, you know, you grabbed a competitor's product, you start reverse engineering, that is not going to qualify for that R&D tax credit. Just some additional common misconceptions. A lot of people think R&D, they think lab coat, test tubes, we're doing some type of formula. That is not what, I mean, that could be qualified for R&D, but R&D goes well beyond that. And honestly, a lot of the times manufacturers are doing these R&D activities on a daily basis. So it's a matter of just making sure we're tracking that, making sure your team's aware of what we want to be tracking in terms of R&D, and making sure we're capturing those eligible costs and claiming these credits, especially if it's something that you're doing already. Trying to build what customers design often qualifies. So I see this a lot if you're maybe more of a contract manufacturer. So maybe some of your customers are coming to you with products that they want you to develop. That is something that we can look at as well. Generally speaking, when we're looking at the R&D tax credit, we want to make sure that you retain the IP or the know-how to that research. So a lot of the times when you're in that contract manufacturing realm, maybe your customer is the one that is retaining that IP. So they might be retaining the IP on that product. But a lot of the times there are process improvements that we can be looking at in terms of the R&D credit that you would be retaining the IP to. So that's something to consider as well. And then just some common questions to ask yourself if you're not already claiming an R&D tax credit, or maybe you are and want to make sure that you are maximizing that credit and we're not leaving anything on the table. Ask yourself, are we trying to make anything that's more efficient? Are we trying to make something faster? Are we trying to make something cheaper? That could be an R&D activity that we could look at. Are you paying for engineering or software development or scientific services? Are you attempting to improve your manufacturing process? As I mentioned before, I think that the process improvements are often the most overlooked R&D aspect. So definitely making sure that we're considering that when we're looking at R&D activities and if an R&D study makes sense. So this is just a nice chart I like to share. I think this really visualizes how powerful this credit can be for the manufacturing industry specifically. So this is a little older. It's hard to believe that 2018 is so long ago. But this just breaks down what industries were really seeing those R&D tax credits claimed. And as you can see, a majority of the R&D credits are claimed by manufacturers. And like I said, a lot of it is because a lot of you are conducting R&D on a daily basis. And like I said before, it really comes down to, are we capturing those costs properly? Are we educating our team properly to know what we should be tracking in terms of R&D tax credits so that we can make sure that we're not leaving anything on the table? So we just spent a lot of time talking about qualified R&D activities. The next question is, okay, so if we know we're conducting R&D activities, how do we calculate that credit? So there are some main expense categories that are going to go into calculating that credit. Generally speaking, the R&D tax credit is going to be a wage-driven credit. So what that means is a majority of the credit is going to come from the wages that you're paying your employees that are performing these R&D activities. So a lot of the times, when we think R&D employees, we're probably thinking our direct engineers. Maybe your team has a specific R&D team or an R&D head that's overseeing a lot of R&D activity. That is definitely a lot more straightforward when it comes to employees and employee time that we're looking at for purposes of the R&D tax credit. Some additional employees that we'd want to look at, we would also want to make sure that we're considering anyone that is directly supervising employees that are directly conducting R&D activities. So maybe, like I said, you have an R&D chairperson who oversees a lot of that R&D activity. They may not be the ones physically doing the R&D, but if they're directly overseeing that R&D that's occurring, then that could be qualified time that we would want to take into account as well. Let's say maybe you are running a prototype through your manufacturing line and you need one of your line workers to be out there helping run the machinery. They are not directly involved per se in that R&D activity, but they are assisting in providing support for that R&D. And that is another, time category that we can look at. So a lot of the time, we're often overlooking a lot of qualified time that can qualify for the credit, because in our minds, we're only thinking, you know, our main engineer and maybe our main R&D person, but really there's a lot of additional people that are helping with that R&D process throughout the year that we want to make sure that we're capturing the costs for. The next one that you will oftentimes see would be supplies used in the R&D process. So an easy way to think about this, if you are creating a prototype, you know, the supplies that are going into that prototype could qualify for the R&D tax credit. Or maybe you are running a test line through your manufacturing process because, you know, we're trying to do a process improvement. Supplies used in testing that could also be qualified for that process improvement. I do want to note that supplies does not include anything that is depreciable in nature, even if it's not depreciated. So for example, if I purchase a piece of equipment to use in my R&D process, that piece of equipment, because it's depreciable in nature, is not eligible under supplies. However, spoiler alert, that's something that we'll want to look at for a different New York State tax credit that we'll get to shortly. The last category that we really see for manufacturers in terms of R&D expenses is going to be contract research. So generally speaking, contract research does have a 35% haircut. So usually we're only going to be able to take into account about 65% of those costs when we're calculating the credit. Under certain circumstances, we could still take in 75% or 100%, but generally we are looking at only 65%. Reason being is the IRS is really trying to promote in-house R&D and hiring your own employees to help with that R&D. Contract research would be an example. Something I see all the time would be maybe you are creating a new product and you don't have the testing capabilities in-house. So maybe you're contracting with a third party to have them do the testing on their end. So that's something that we would want to look at in terms of qualified contract research. The last expense category, I listed it here. Really, you're not going to see this with a manufacturer. This is primarily going to be more in the tech industry, but rental or lease of computers or cloud computing is, you know, one way to oftentimes think about that. So those are the expenses that we talked about. So we talked about what activities qualify for the R&D tax credit. We talked about what expenses go into that R&D credit. You're probably asking yourself, what is the benefit of all of this? So generally speaking, when we're looking at an R&D tax credit, it's usually going to come out between, you know, somewhere between, let's call it 6 to 9% of our qualified research expenses. Those qualified research expenses would be the wages we just talked about, the supplies, and the contract research. So that's the benefit there. Something I will add too is that here at Lumsden, we will never recommend something unless we truly think that there is a cost benefit in it for you. So something that I like to do, especially if maybe you're new to the R&D tax credit world, is we'll recommend doing a high-level back-of-the-napkin cost-benefit analysis. And generally what that is it's a 50,000-foot view of, okay, these are your R&D activities that you've identified. These are the potential costs that have been identified. This is about where we think that R&D tax credit will come out to be, and this is what we think the cost of conducting a study would be as well. So definitely something that if you're interested in, we are definitely here to help. Going back to this tax credit in terms of benefits, as I mentioned at the start of this topic, the federal R&D tax credit is an income tax credit. So generally speaking, it's going to offset the federal income tax related to the entity. Now, if you are a C corporation, it's going to offset the income tax at the entity level because a C corporation is an entity that pays tax in and of itself. If you are a partnership or an S corporation, where all of your income and expenses flow through to the owner, then that R&D tax credit will also flow through to the owner and help offset the tax, the federal income tax at the owner's level. Now, if the entity qualifies as a small business per the IRS, then that credit can also potentially offset AMT at the personal level. AMT stands for alternative minimum tax. I won't bore you with the complications of what exactly that entails, but basically it is an alternative way to calculate federal income tax on the 1040. So something to note too is that this R&D tax credit can be carried back for 1 year and carried forward for 20 years. Now, this is very beneficial in the event that, maybe we have an uptick in R&D activities in a given year that we don't think we're going to have in future years. Generally speaking, as long as it makes sense from a cost benefit standpoint, we might want to go ahead and claim that R&D credit in the year that we have those expenses if we don't think we're going to have them in future years, so that we do have a credit to use down the road when we do have taxable income. People that work with me will know that I often use the term our tax treasure chest. So we want to add that tax credit to our treasure chest so that we have that in the future when we need it. Also, as I mentioned, this is a federal income tax. There were some changes to the federal R&D tax credit to make it more favorable for certain startup businesses. And trust me, the IRS's definition of a startup business is very different than what you and I might describe as a startup business. But if you meet the IRS's definition of a startup business, then you actually have the opportunity to have this be a refundable payroll credit. As I mentioned, it is a payroll credit, which means it would be claimed on your quarterly 941s and would help offset the employer portion of FICA taxes. So if you are a startup company, generally speaking, you are operating with losses. We don't have any federal income tax to offset, but we probably have a lot of R&D activity because we're just starting off. So this helps those startup companies monetize those credits and then also be able to increase cash flow and make sure we have enough runway, because that's one of the most important parts when you are a startup company. One other quick topic, I just talked about some good things with the federal R&D tax credit. This isn't quite as good, but it's definitely something that you need to be aware of. I know if you attended the February BNMA meeting, Peter called me out on this because he knows that I have been talking about this nonstop for the last about year and a half. But currently, for tax years beginning on or after 1/1/22, R&D costs are required to be capitalized and amortized over 5 or 15 years, depending on where that R&D is happening. So what does this mean? If you think to maybe your 2021 tax return, if you had $1 million of R&D expenses, you were then able to deduct those $1 million of R&D expenses currently in the year that you incurred them. So if I had $1 million of R&D in 21, I deducted $1 million of R&D. Starting with the 2022 tax year after 1/1/22, if you were a fiscal year, that R&D now must be capitalized similar to a fixed asset. So similar to what you're doing when you are purchasing equipment. It then must be amortized over 5 years if that research is conducted in the US, or 15 years if that research occurs outside of the US. So if we go back to my example of, let's say I had $1 million of R&D in 2022, I can only take a deduction on essentially 10% of that if the R&D is conducted in the US. So as you can imagine, this has a huge, huge, huge impact to taxable income for a lot of companies. So I like to share this chart because we just kind of went through what those R&D expenses looked like in terms of the federal R&D tax credit. It's important to note that Section 174, which is what this R&D capitalization falls under, is even more broad in terms of what expenses qualify as R&D expenses. So as you can see on the Section 174 side, you know, the wages we talked about with R&D credits, the supplies we talked about, and that contract research we talked about would still be included. But then it's also going to include more indirect expenses, such as your overhead, so rent or utilities. It's going to include depreciation. It's going to include patent fees. So if you're paying an attorney for, you know, filing a patent, that's something that we would have to look at. Payroll taxes are something that this actually includes, including employee benefits related to, you know, the employees that are working in R&D. And also research outside of the US. As I mentioned before, if we have research outside of the US, then that could be subject to a 15-year amortization. So like I said, I don't want this to be a huge negative after we just talked about all of the positives of the R&D tax credit. A couple of things to note. First is that as much as, you know, having to add back the R&D expenses can be painful, I would never recommend making sure that that prohibits us from claiming an R&D tax credit. The Section 174 expenses apply regardless of if you claim an R&D tax credit or not. So even if I don't claim an R&D tax credit for a year, I am still required to add back those Section 174 expenses. Now, something to keep in mind is that the capitalization and amortization, at the end of the day, it's a temporary difference. So it's a matter of, am I taking the expense immediately, or am I recognizing the expense over 5 years? So you still are getting the expense, it's just over a span of time. Whereas this R&D tax credit is going to provide you with a permanent tax savings because it is a tax credit. Another thing, you know, and this is where we'd recommend working with your tax advisor, is that, you know, Section 174 may increase our taxable income, but there's some other planning that we can actually look at to essentially lessen the burden of the Section 174 add back. There are things such as, and we'll talk about this later on, the FDII deduction that we could be looking at. It could free up 163J and make it so that our interest expenses deductible. So there's definitely some planning to go into here as well. The last thing that I do want to mention on this is that there is bipartisan support to either postpone this requirement and go back to 100% expensing, or to completely eliminate it. I have personally been watching this since about 2020. There have been numerous bills announced. Most recently, there was a bill that passed in the House. However, it's currently stuck in the Senate. It's not looking promising at the moment, but I can say based on all of the R&D conferences that I have attended, that it is felt by most people in the profession that this will be changing at some point. It's just a matter of when will it change. So there is still hope that this does all go away, but as it currently stands, these are the rules that are in place. With that being said, I think that brings us to our second polling question.
All right, everyone, second polling question here is, does your manufacturer currently take advantage of R&D tax credits? And we are at the halfway point. It's 12:32, so got about halfway to go here. All right, I'm gonna give it another second or two and I'm gonna end the poll, and I will share the results. It looks like it's a 50-50 split almost, that some of you are taking advantage, others aren't. All right, go ahead, Kristen.
Thanks, Maria. All right, so R&D is very near and dear to my heart, so I'll try to speed it up for some of this. I do have some information in the slides because I had a feeling I wasn't going to make it through everything, because once I start talking, there's just no stopping me. All right, Excelsior Jobs Program. So we just talked about a federal income tax credit with the R&D tax credit. Excelsior Jobs Program is a New York State tax credit. A lot of the times when we're talking about New York State tax credits, you might hear as of rights credits. So basically what that means is just because I am a New York State manufacturer, there are certain credits that I am eligible for. And we'll kind of get into what those are. Excelsior Jobs Program is not an as of right credit. It is a credit program that you must apply for. And I cannot emphasize this enough, but before you are hiring more employees and before you are looking at maybe, revamping your manufacturing facility, or before if you're trying to buy a new location, before you do any of that, make sure you talk to us, because it is very likely that you could potentially meet the criteria to apply for the Excelsior Jobs Program. And this can be very, very beneficial for manufacturers. So what is the Excelsior Jobs Program? It is an employment-based credit. So the point of the Excelsior Jobs Program is to promote investment and job creation in New York State. So the Excelsior Jobs Program in and of itself has numerous credits to it. The main credit that you'll usually see is the jobs tax credit. So that's going to be based on how many employees you hire or how many net new jobs you're creating. The credit amount is a maximum of 6.85% of wages of these net new jobs. So the net new job is the new job that you are creating. Also, the Excelsior Jobs Program has the investment tax credit. This is a maximum of 2% on qualified investments that you are making. I will add a little caveat here to make sure you're talking to your tax advisor, because there may be other credits that we might want you to take instead of the Excelsior investment tax credit that are more beneficial. Research and development tax credit. So we just talked about the federal R&D tax credit. Some states also have an R&D tax credit. In New York State in particular, there is only a New York State tax credit for R&D if you are in the Excelsior Jobs Program. And what that credit is it's a maximum of 50% of the federal R&D tax credit. I did list out here the real property tax credit. We won't go into too much detail on that, because that honestly, we don't really see that too often, because there's quite a bit of criteria that have to be met to reach that credit. So when you apply for the Excelsior Jobs Program, you complete an application and you essentially let Empire State Development know how many jobs you think you're going to create over the next 5 years, what level of investment you think you're going to bring in terms of capital investments. So whether I'm like purchasing a new building, maybe I'm adding some improvements to a building, so on and so forth. Once that application gets submitted, New York State then analyzes that data. They have a proprietary formula to give them a cost benefit on your project. And they use that formula to determine what your maximum credits are that you will receive over the course of 10 years. So maybe you're going to receive credits over the course of 10 years for $100,000. They will issue you a schedule that includes the amount of net new jobs that you must create to be awarded those credits, and the maximum amount of credit that you're awarded for each year. So they do give you a schedule that kind of breaks all of that down. Now, in order to be eligible for the credit, like I said, you have to meet your net new job commitment. So let's say I am a manufacturer and I currently have 5 employees before I enter the program, and I have to hire 1 new employee for my first year. So let's say in January, I hire my new employee, but then in May, I lose one of my original 5 employees. So my net headcount is still just 5 employees. I went from 6 and then I went down to 5. That, because I had to backfill a job, that new hire would not be considered a net new job. So really, when we're looking at net new job, we're looking at the overall increase in your employment. And now I know I mentioned this at the start of this, but like I said before, it is extremely important that we are looking at this before we're hiring and before we are investing in new facilities, because there is an application and there is an application process to get accepted into the program. It must be signed. So there's a whole process once you even submit an application. And anything that you do before you are fully in the program, which means before everything has been signed and, documented with New York State, anything done before that point does not count. So if I hire employees before I'm in the jobs program, then I am not going to get credit for that. So that's why it's extremely important to make sure you are talking to us as soon as you think we're going to be hiring employees, or as soon as you think we're going to have a project. As I mentioned before, you have to meet that job requirement in order to be awarded credits. So to get into the program, a manufacturer must commit to creating at least 5 net new jobs. So, like I said before, if you're looking at your hiring prospects and you're thinking, wow, I'm probably going to hit that in year 2, and I think I'm going to hire another 5 after that, then let's talk about Excelsior, because there's probably some opportunity there that we don't want you to miss out on. In order to be awarded credits, you must meet at least 75% of your job commitment. This is just a definition of what New York State defines as manufacturing for purposes of the Excelsior Jobs Program. I won't read this in detail because I know we are going to be tight on time, but that is there as well. And then also, if you maybe don't think we're going to hire a bunch of new employees, but we have significant capital investment, that's something that we could also look at. There's a different track for that. However, it tends to be a little bit more difficult because there has to be a significantly high cost benefit ratio in order to be accepted that way. All right, so that was a little bit on Excelsior. So sticking with New York State tax credits, so we're going to switch gears over to the New York State investment tax credit and the employment incentive credit. So we were just talking about as of right credits. These are 2 as of right credits. So these are credits that we don't have to apply for. We can just claim them on our New York State tax return. So the New York State investment tax credit is going to be a tax credit on qualified property, whether that be tangible personal property or buildings and structural components that are used in either manufacturing or R&D. That's really what we're going to be looking at for a manufacturer. The credit ranges between 4 to 9% of your investment base. Your investment base is going to be your qualified cost. The credit is 4% if you are an S Corp, 5% if you are a New York State C Corp. When we're looking at R&D property, it does have a higher percentage. It's 7% for S Corps and up to 9% for C Corps. So who's eligible for the ITC? Any business that has placed qualified property in service during the year and that has property located in New York State. So when we were talking about qualified property, we kind of get into this in the next slide. We're looking at that manufacturing property or that R&D property that meets the requirements. And this just reminded me too, something to note real quick on that Excelsior Jobs credit is that Excelsior is a refundable credit. Refundable credits are your best friends because what those mean is even if I don't have a tax liability, I get those credits refunded in cash and they put cash back in my pocket. So like I said, the Excelsior Jobs credit is a refundable credit. The investment tax credit can potentially be a refundable credit. It is refundable if you are a new business, which means you are operating in New York State within your first 5 years. If it is no longer a refundable credit, then it can be carried forward for either 10 years or 15 years. And once again, the 10 years is for an S corporation, 15 years is for a New York State C corporation. So real quick, qualifying property, as I mentioned, this is going to primarily be your tangible property in your buildings. They must be located in New York State. They must have a depreciable life over 3 years. They have to have been acquired by purchase. There are special rules for related party purchases. They must be used principally in manufacturing or as R&D property. So as we talked about when we were looking at the R&D tax credit, and I mentioned that, if I purchased a piece of machinery, I couldn't include that in my federal R&D tax credit if I was going to use that in my R&D process. However, you would want to make sure that you're looking at the investment tax credit for that property, because we might be able to take a New York State credit on that instead. And just real quick here, qualifying property does not include property that you're leasing to others. If you're in the business of leasing equipment or anything, that's something that's not going to qualify. Property that's not used directly in the manufacturing process, so furniture, fixtures in the office, computers in the office, and things like that. Public warehouses used to store goods that would not be qualified. And then also excavating and road building equipment and electricity generating equipment. Now there's a little sweetener to the investment tax credit, and it's called the employment incentive credit. And essentially, if I've claimed an ITC in 1 or 2 previous years, then I could be eligible for the employment incentive credit on that same tax base. So let's say I claim an investment tax credit in 2020. I then, assuming I increase my employment, because I have to increase my employment over my base year in order to be eligible. If I took that ITC in 2020, my employment increased over my base year in 21, I get to take that initial cost that I claimed the ITC on, and I can take up to an additional 2.5% of a credit on that same base. And then, let's say in 2022, I still have employment that's higher than my base period. I, once again, could take another 2.5% on that base. So that's really where this employment incentive credit can kind of help, as I mentioned, sweeten the incentive tax credit even more. All right, and I think that brings us to polling question number 3.
Yes, polling question number 3 is, have you made property investments the last 6 months, 1 to 3 years, or in the last 4 to 5 years? So we usually give about 30 seconds for the polling question, so I will end it and share the results. All right, I'm gonna give another second. I'm gonna end the poll here and we'll share the results. So it looks like most people, and recently, it's great to see in the last 6 months, over a third of you guys have invested, and then 1 to 3 years came in at the highest level at 42%.
Awesome. All right. So moving right along here, other New York State manufacturing benefits. New York State is very manufacturer friendly. It's definitely a targeted industry where they are trying to essentially promote manufacturers in coming to New York State and manufacturing in New York State in and of itself. So in addition to some of those credits that we just talked about, there is also a 0% corporate New York State tax rate for manufacturers. So if you meet the definition of manufacturing, which there are a couple here, so if you have greater than 50% of gross receipts that are derived from manufacturing, also if you have tangible property in New York State that's used in the production of goods by manufacturing that has an adjusted basis of at least $1 million at the close of the year, or all of your real and personal property is located in New York State, then you may meet this definition of a New York State manufacturer. So really where this comes into play is if I meet the definition of a New York State manufacturer, and if I am a New York State C Corp. So this does not apply to S corps. If I am a New York State C Corp and I meet this definition, then I have a 0% New York State income tax rate. So even if I make $1 million and I have $1 million of taxable income, if I meet the definition, I don't pay any tax on that for New York State income tax purposes. There's also another credit that can be claimed on a tax return if you are a manufacturer and if you are paying real estate taxes. So the credit is 20% on your qualified real estate taxes. That does only include the manufacturing portion of the facility, so you would not take the credit on the office portion. There are also specific rules for property taxes paid when the property is owned by a related party, and some things to look at for that. So definitely something to look at with your tax advisor. And something I do want to note here too is, we just talked about how if you're a C corporation with New York State, you have that 0% manufacturer's income tax rate. Something to keep in mind too, and this is where really working with your tax advisor comes into play, is even if you are a New York State S corporation, by taking the real property tax credit, the investment tax credit, the employment incentive credit that we just talked about, maybe you're also in Excelsior, by taking all of these different credits into account, it is very likely that your New York State tax could be very minimal, even if you are an S corporation in New York State. So that's something to work with. And I think I mentioned this later on in the planning opportunities, but something to work on with your tax advisor in terms of your tax planning of, does it make sense to be a New York State C Corp, or do we want to stay a New York State S Corp, and what do those tax differences look like? Just real quick, some other New York State tax credits are listed here. Just a few that I want to point out: brownfield credits and historic rehabilitation credits. If you're looking to renovate your facility, or maybe you're purchasing a new building and you're going to renovate that new building, definitely make sure you're talking to us about that so that we can help from a credit standpoint, because there is a lot of credits that help with that level of investment. And then also just a quick note on sales tax exemption certificates. So, we have a great sales tax team here at Lumsden, but making sure that you have the correct exemption certificates and that you are not paying New York State sales tax where you shouldn't be. Something that's very interesting is we can do oftentimes what's called a reverse sales tax audit, where we actually go in and we try to determine if you're paying too much New York State sales tax, and we can try to see if we can potentially have that New York State sales tax refunded if you were not supposed to pay that in the first place. So we just spent a bunch of time looking at New York State credits. One more federal credit just to be aware of, it's the work opportunity tax credit. And basically what this looks at is there is a federal tax credit if you are hiring certain targeted employees, those that were previously incarcerated, certain veterans. Those are examples of people that may qualify for this credit. There is paperwork that has to be filed within 30 days of hire. So this is just something to be aware of as you're onboarding new employees and making sure that you're looking at this. So once again, we're making sure that you're not leaving any money on the table. There was also just a Lumsden article, I believe, on the work opportunity tax credit. So be sure to check that out. That has a bunch of additional information as well. Just some other local incentives to mention if we are looking at, a new building or a new project that we're looking at. Always make sure you're considering your local IDA to see what benefits they have. There are pilot programs and things of that nature there as well. New York State has a bunch of other tax credit programs and labor training grants. National Grid, National Fuel, and NYSEG all have incentives, as well as NYSERDA and NYPA. So once again, make sure you're talking to us if we're looking at these projects, because we want to make sure that we are maximizing those tax incentives. And once again, I think that brings us to our final polling question.
Yep, here's an here's an easy one. Are you a member of the BNMA? It's just kind of a fun little question to get in some polling questions, so. Let's have full participation, so I'm gonna give that another few seconds. All right, I'm gonna end the poll here and we won't share that one. So Kristen, you can go ahead.
All right. So I believe this is one of our last sections. Just real quick, some tax planning opportunities. So we just talked about a lot of credits and incentives and things to be thinking about, things to talk to your tax advisor about. In addition to those, there are some additional tax planning opportunities outside of tax credits and incentives. One of those opportunities is, are we considered a small business for purposes of the IRS? And if so, can we look at maybe changing our method of accounting? One of those examples would be switching from accrual basis to cash basis. So maybe your financial statements are on the accrual basis. If we meet the definition of a small business, then we potentially could look at switching to the cash basis for income tax purposes. And you may be asking yourself, why is this more beneficial? Depending on what your receivables and your payables or your accrued expenses look like, or your prepaid expenses for that matter, depending on what those look like, this could actually defer the recognition of income. So another point I like to point out with cash basis is it gives us a little bit more control in terms of tax planning. So obviously on the receivable side, there's not too much that we can do there. When you're invoicing your customers and when they're paying, we don't have control over that. However, when we're looking at the payable side of things, we do kind of have a little bit more control in terms of, do we want to maximize taxable income or do we want to mitigate taxable income? If we want to mitigate taxable income, we might suggest paying down your payables as much as possible before the end of the year. The reason that is when I'm on the cash basis, generally speaking, when cash comes in, that's going to be revenue. And generally speaking, when cash goes out, that's going to be an expense. So if I'm paying down my payables before the end of the year, cash is going out the door, I'm getting the expense for that. And then on the flip side, if we don't want to pay down our payables and recognize more taxable income in a year, then we can do that as well. Another couple of things that I'd mention here, percentage completion. So maybe you are required for financial statement purposes to account for, your long-term projects using the percentage of completion method. If you meet the definition of a small business, we could potentially look at switching you over to completed contract for tax purposes, which would result in a deferral of income until that project is complete. Another item listed here is UNICAP. So just to, kind of familiarize you with UNICAP, basically what that means is it's taking additional indirect costs and capitalizing those on the balance sheet as opposed to deducting those costs. So even if you are probably already taking some of your indirect costs and allocating that to your cost of goods sold, the IRS is still requiring us to go in and capitalize some of those indirect costs and put them up with inventory as opposed to taking the deduction in the tax year. Which obviously, if I'm taking it out of my expenses and putting it on the balance sheet, then that's going to increase my taxable income. So if you meet this definition of a small business, then we may not have to look at UNICAP. Just some other tax planning opportunities listed here. Bonus depreciation. So bonus depreciation essentially allows me to expense for 2023 up to 80% of that asset in the tax year. So if I purchase a piece of equipment, let's say it's $10,000, I can take bonus depreciation on it and I can immediately expense $8,000 of that. This is something that's changing with tax reform. It's set to go down to 60% for 2024. I will throw out there that bill I talked about earlier for R&D, there's also something in there to change bonus depreciation back to 100%. Bonus depreciation was 100% for 2018 through 2022. So it's slowly set to start phasing out. And there is bipartisan support to try to eliminate that phase out. Now, section 179 is very similar to bonus depreciation. Essentially, if I purchase property in the tax year, I place it in service and it's section 179 eligible, I could be eligible for an immediate expense of that as well. There are certain thresholds and requirements to meet for section 179. And this is another planning aspect with your tax advisor, because a lot of the times we might elect out of section 179 and instead claim bonus depreciation, because we are able to then claim certain New York State credits that we cannot otherwise claim if we claim section 179. So that's a planning aspect for sure with your tax advisor. The last thing here is just the foreign derived intangible income deduction. This could be applicable for a C corporation. And I think I mentioned this before, the FDII deduction. That is just a deduction if you have, foreign sales and you are a C corporation, then that could be something that we could look at as well to help reduce taxable income. The one thing I just want to mention real quick on this slide, I'm just about done here. I know I only have a couple of minutes. There is a lot of uncertainty right now with upcoming tax law. Right now, the Tax Cuts and Jobs Act that passed back in, I want to say 2017, has a lot of provisions that are set to expire in 2025. And on top of that, as I'm sure most of you are aware, we have an election coming up. So there is a lot of uncertainty in terms of what some of these future years look like from a tax standpoint, especially when it comes to, okay, is our tax rates going up or are they staying the same? So really, making sure that you're working with your tax advisor. I know here at Lumsden, this is something we are constantly watching, we are reading, we are listening. That way we can make sure that we are properly serving our clients. So just something to keep in mind, that there is a lot of uncertainty in terms of what some of these years are going to look like when it comes to tax planning. The last slide I had here, I had a feeling I wouldn't get to, so I'm just going to summarize this by saying, I mentioned before, if you have a project going on, if you're hiring employees, please make sure that you're talking to your tax advisor. Same thing for the Inflation Reduction Act. There are a lot of pieces of this act that can benefit manufacturers. So just make sure that you're communicating with your advisor to make sure that we're aware of what's going on. And we will also make sure that we're communicating this to you as well, to make sure that we aren't leaving anything on the table. And with that being said, I have my contact information there. Thank you everyone so much for joining us, and hopefully everyone is going to go enjoy the basketball. Have a nice beverage.
March Madness.
It's well deserved after listening to me talk about tax for the last hour.
So I put Kristen's contact information in the chat. I know we're just at the hour, but does anyone have any questions? There are none in the Q&A section, but we'll hold on for a second here if anyone does have any questions. Also, there is a survey that will launch. I mentioned it in my introduction. If everyone could please take a minute to just quickly answer that. It should take you about a minute to do. We'd appreciate it. Okay, I don't see any questions coming in, so we'll close here. And again, thanks to Peter Aherns and the BNMA, and of course to Kristen for giving us a great overview of the tax credits. And Lumsden and McCormick is always available to help everyone out. So give us a call. Take care.
Thank you.
Bye. Thanks, Kristen.